You know how sometimes you see a company pop up, loads of buzz, promising something totally new?
Yeah, like this is it, the next big thing.
Exactly. And you think, okay, maybe this one will change the game. But then fast forward a few years.
And the story changes. Maybe not so revolutionary after all.
Right. And you hear whispers, maybe it's getting pulled back into the mothership. That's kind of the story we're digging into today with Carrot General Insurance.
Carrot launched as Korea's first digital non-life insurer, right? Big splash.
Huge splash. But now, yeah, the journey's taken a bit of an unexpected detour, potentially towards absorption by its parent, Hanwha General Insurance.
Which is interesting because Carrot wasn't just any company. It was meant to be this, like, shining example of digital innovation in a pretty traditional sector.
Totally.
So the fact we're talking absorption now by Hanwha, well, it makes you really want to unpack the why, doesn't it? What exactly went wrong?
Absolutely. And there's a key figure here we need to talk about. Kim Dong-won.
CEO of Hanwha Life, big player in the whole Hanwha financial group.
Right. And Carrot was seen by many as, well, his baby, his passion project, you could say, the flagship for Hanwha's digital finance dreams.
So this situation, it definitely puts a spotlight on his leadership, doesn't it? And maybe raises questions about how that whole digital strategy played out.
It really does, because if you look at it, Carrot wasn't some, scrappy garage startup.
No, not at all. It had serious backing from Hanwha, a major conglomerate, and attracted some hefty investment early on, too.
So the big question for us today, the mission for this deep dive, is how did this symbol of digital progress end up here, facing absorption, after only 6 years?
Yeah. What were the key factors? That's what we need to figure out.
Precisely. We've got some great sources laying out Carrot's journey, the financials, the Hanwha context. So let's get into it. Okay, starting point, 2019, the launch. Big deal. Korea's first digital non-life insurance company.
And Kim Dong-won's involvement right from the get-go was really significant.
Not just overseeing it, but actively architecting it.
Seems that way. He was seen as the driver behind Hanwha's whole digital finance push, and Carrot was supposed to be the proof in the pudding.
And the initial buzz wasn't just hype, right? Real investors came on board.
Oh, yeah. Big names. Obviously, Hanwha General Insurance itself was the main shareholder, nearly 60% at launch, reportedly.
Okay.
But you also had SK Telecom, Hyundai Motor,
Wow.
Altos Ventures, Estic Investments, serious players putting money in.
So this wasn't a small bet. It was positioned as Hanwha saying, look, we're serious about digital finance.
Exactly. It was meant to signal a real shift, a transformation within this, traditional financial giant, more than just another insurance company.
And the product that really caught people's eye was the per-mile auto insurance.
Yes, the pay-as-you-drive model.
Can you break that down a bit? Why did that resonate?
Well, the idea is pretty simple and honestly quite appealing. Instead of paying one flat rate for your car insurance.
Like most of us do.
Right. Your monthly cost was directly linked to how many miles or kilometers you actually drove.
Okay, so low mileage drivers benefit.
Precisely. They use this little IoT device, the Carrot plug, plugged into your car to track the distance.
Clever.
And the appeal was obvious, especially if you don't drive much. Why pay the same as someone commuting 2 hours a day?
Right. Makes total sense. And it looks like it worked, initially anyway. The numbers show they pulled in over 2 million subscribers in just 4 years. That's pretty fast growth.
It is impressive. And a 90% renewal rate. That suggests customers who signed up actually liked the service itself. They weren't just churning out.
High satisfaction then. So where did things start to go sideways?
Well, that initial success, grabbing all those subscribers, it showed real market demand for the idea. People like paying less if they drove less.
But
The underlying economics, the actual revenue model, just didn't seem to hold up, despite the subscriber numbers and the loyalty.
so lots of happy customers, but not enough money coming in. How does that happen?
It boils down to the unit economics, it seems. You
Yep.
attract low-mileage drivers, which is the point. But by definition, they generate lower premiums. Meanwhile, you've got these pretty significant fixed costs.
Like what?
Developing the tech platform, maintaining it, making and distributing all those Carrot plug devices.
Yeah, the hardware costs.
Exactly. Plus, marketing, customer acquisition, getting those 2 million subscribers costs money. So the revenue per customer just wasn't enough to cover all that.
Especially if the cost of that plug itself was high. Did they, give those away or charge for them?
That's a good question. The details aren't fully clear, but it represents a significant upfront and ongoing cost regardless. You wonder if that cost maybe outweighed the slightly lower claims potential from those drivers?
Yeah, tricky balance. And the sources also mention the Korean auto insurance market itself is just tough.
Oh, incredibly competitive. It's dominated by these huge established players with deep pockets.
So even with a cool new product, you're fighting uphill just to break even, let alone make a profit.
Precisely. It's a difficult environment for any newcomer, innovative or not.
Okay, so the core product had issues. Did they try to, branch out, move into other insurance areas?
They did try, but that's where they hit another major wall. Regulations.
Ah, regulations. Always a factor in finance. What were the specific hurdles here?
So Korean rules for these digital insurers had this specific requirement. Over 90% of your premiums had to come from non-face-to-face channels.
Meaning online or through apps, basically. No agents?
Essentially, yeah. Which sounds fine for a digital-first company, right? Fits the brand.
Blood it. There's always a but.
But it seriously limited their ability to expand into other, potentially more profitable insurance lines.
Like what kind of lines?
Think about things like long-term care insurance or complex health policies, stuff that often needs, a proper conversation, maybe some advice from an agent.
Right, things you might not just click buy for online without talking to someone.
Exactly. Selling those effectively purely non-face-to-face is tough. So that 90% rule kind of boxed them in. The data shows over 84% of their actual earned premiums ended up coming just from auto insurance.
Wow, 84%. So diversification just didn't happen. Did they try to find ways around it, like partnerships or different digital approaches?
It seems their attempts weren't very successful if they did. The outcome was they remained overwhelmingly dependent on that one, challenging auto insurance market.
So they were pretty much stuck with the per-mile auto insurance, which, as we said, had its own profitability problems.
That's the picture, yeah.
Yeah.
They did launch a few other things, employee health plans, phone insurance, travel insurance.
Okay, some smaller ticket items.
Right. But none of them really took off or made a significant dent. And there was even a B2B partnership attempt in Indonesia that didn't pan out.
So attempts were made, but no breakthroughs beyond that initial auto product.
Seems that way. A compelling initial idea, but real struggles in building a broader, sustainable business on top of it, partly due to those regulatory walls.
Which leads us, inevitably, to the financials. And looking at the numbers, well, it's not pretty.
No, it's quite stark, actually.
Yeah.
Carrot never turned a profit. Not once in its 6 years.
Never.
The losses just kept mounting. It's 2020, a net loss of 38.1 billion Korean won.
Okay.
2021, it jumped to minus 65 billion.
Getting worse.
Then peaked in 2022 at negative 84.1 billion won. Dropped a little in 2023, but still a huge loss of 76 billion.
Good grief, if you add that all up.
You're looking at over 300 billion won in cumulative losses over its short lifetime.
That's a staggering amount of money. And that core product, the per-mile insurance, was a big part of that drain. You mentioned the loss ratio.
Absolutely crucial point. The loss ratio for that product was, at times, over 100%.
Meaning, for every one they collected in premiums, they were paying out more than a one in claims and expenses.
That's exactly what it means. Unsustainable is the word.
Yeah.
Even in 2023, it was still hovering around 98.8% to 101.8%. Way too high.
A clear sign the fundamental model wasn't working financially.
Definitely. A loss ratio consistently that high is a massive red flag in the insurance world.
So how did they even keep the lights on with losses like that year after year?
Capital injections, lots of them.
From the parent company, Hanwha.
Primarily, yes. There were 3 big rounds of raising capital. June 2021, about 100 billion won. August 2022, another 175 billion. And then December 2023, just recently, 130.5 billion.
Wow, adding up to around 400 billion won in total injections.
Roughly, yes. And Hanwha General Insurance participated every time, keeping their stake often above 60%, pouring money in to keep it afloat.
So Hanwha kept the faith, or maybe felt they had to. But even with all that cash, trouble was brewing, right? Something about their solvency ratio.
Yes, the KICS ratio. It's a key measure of an insurer's financial health, its ability to meet obligations.
And regulators watch that closely.
Very closely. There's a minimum requirement, 150%. By the end of 2023, Carrot's ratio had dropped to 156.2%.
Oh, that's cutting it incredibly fine, just barely above the minimum.
Dangerously close. A ratio that low rings serious alarm bells internally and with regulators. It almost certainly forced the conclusion that, Carrot couldn't continue as an independent entity. The risk was just too high.
So it really paints a picture. Innovative idea, initial traction, but ultimately sunk by a flawed economic model, regulatory roadblocks, and just massive mounting losses that even hundreds of billions in funding couldn't fix.
That seemed to be the essence of it.
And this whole situation, as we mentioned up front, really reflects back on Kim Dong-won's leadership.
It does. This becomes a really interesting part of the story. Carrot was widely seen as his first major independent initiative within Hanwha's financial companies.
His big bet on digital.
Exactly. So its likely absorption now, well, it's undeniably a significant setback for him personally and professionally. Many are framing it as, frankly, a failure of that key venture.
And the timing is interesting, too, with comparisons being drawn apparently to his older brother.
Right, Kim Dong-kwon. The reports suggest he's had more, let's say, visible successes leading other parts of the Hanwha empire, like defense and energy.
Ah, that internal dynamic. Within these large family-run conglomerates, those comparisons must add pressure.
You have to assume so. Successes and failures are noted. And remember, their father, Chairman Kim Sung-yeon, transferred a big chunk of his shares to the three sons just last year.
Raising the stakes for all of them to prove themselves.
Exactly. So for Kim Dong-won, this Carrot situation inevitably leads to questions about his strategic direction and execution in the financial sphere. You have to ask, what were the assumptions, maybe miscalculations, that led here?
And it's not just about the business result, is it? The sources suggest experts see this as more than just a company failing. It's a strategic fumble.
Potentially impacting his credibility, yeah. And maybe his influence or autonomy within the group going forward. When a high-profile project so closely tied to your vision doesn't succeed,
It has consequences.
it often does. It might affect resource allocation for future projects, the level of trust placed in his strategies.
There was even that slightly odd side story about the basketball team sponsorship, the Goyang Carrot Jumpers.
Ah, yes. A bit unfortunate, that one. Carrot took on the naming rights for the team.
Yeah.
But then, reportedly due to financial issues within the wider Hanwha group supporting the team actually got expelled from the Korean Basketball League.
Oh, wow. That can't have helped Carrot's brand image.
Probably not. Likely just added to a perception of financial instability, even if indirectly linked. Just bad timing and optics.
So putting it all together, Carrot starts with this big promise, digital innovation, serious backing,
Full of potential.
but runs headfirst into, well, reality. A tough revenue model for its core product, regulations that block diversification, and just unsustainable losses despite massive funding.
Confluence of factors, really. Each one potentially manageable on its own, perhaps, but together.
Too much. And the whole episode inevitably casts this shadow over Kim Dong-won's leadership and his digital strategy for Hanwha's financial side.
It really does. The Carrot story ends up being this, well, compelling case study, maybe a cautionary tale,
Yeah.
about just how hard digital transformation can be, especially these established, heavily regulated industries like insurance.
It really highlights that just having cool tech or a neat idea isn't enough, doesn't it?
Absolutely not. You need a viable, adaptable business model underneath it all, and you need to be able to navigate the market, the competition, the regulations. It's the whole package.
So as we wrap up this deep dive, it leaves you thinking, considering everything Carrot ran into, what does it take for a digital-first approach to actually win in a field like insurance? What are those critical pieces?
That's the million-dollar question, isn't it? Or maybe the 300 billion won question in this case.
Yeah. And what lessons can other companies, maybe even outside finance, take away from Carrot's experience as they try to innovate and transform themselves? Definitely something to chew on.